Partners Group Holding, a Swiss-based global private markets firm, currently stands at a juncture where its operational achievements are being rigorously tested by a volatile macroeconomic environment and a shifting investor sentiment. While the firm reported record assets under management of $185 billion and a substantial 20% revenue increase for the fiscal year 2025, the subsequent 37.47% collapse in its share price in March 2026 highlights a tension between the firm's transformational investing narrative and the market's demand for predictable, margin-accretive growth. This report provides an examination of the bull and bear cases for Partners Group, synthesizing financial performance, strategic initiatives, competitive positioning, and the broader regulatory and macroeconomic trends shaping the industry through 2026. The 2025 financial performance. The fiscal year 2025 served as a benchmark for Partners Group's ability to execute at scale, yet it also exposed the vulnerabilities of a business model increasingly reliant on high-velocity realizations to drive total earnings. Total revenues for the period reached 2,563 million Swiss franc, representing a 20% year-over-year expansion that ostensibly signaled a robust recovery in private market activity. This revenue beat was driven primarily by a surge in performance fees, which reached 819 million Swiss franc, a 60% increase from the prior year. However, the quality of this growth was questioned by the investment community, particularly following an earnings per share result of 26.26, which missed the analyst consensus of 27.06 by approximately 2.96%. Revenue composition and management fee stability. The core of the firm's stability remains its contractually recurring management fees, which amounted to 1,744 million Swiss franc in 2025. On a constant currency basis, management fees grew by 12%, although foreign exchange headwinds, particularly the strength of the Swiss franc against the dollar and euro, reduced the reported growth to 7%. The management fee margin remained stable at 1.24%, consistent with long-term historical averages, and underscoring the firm's ability to maintain pricing power despite increasing competition. The stability of management fees is a critical component of the bull case, as it provides the necessary capital to fund the firm's intensive transformational investing operations. These fees are fundamentally linked to the growth in average assets under management, which rose 21% over the period. The firm's ability to grow management fees in line with AUM suggests that it has not succumbed to the aggressive fee discounting observed in more commoditized segments of the asset management industry. Operational leverage and expense dynamics. A primary concern for market participants in early 2026 is the perceived erosion of operational leverage. Total operating costs increased by 22.5% to 953 million Swiss franc, outpacing the 20% revenue growth. This resulted in a slight contraction of the EBITDA margin from 63.6% in 2024 to 62.8% in 2025. Personnel expenses, which constitute 86% of total operating costs, grew by 24% to 816 million Swiss franc, while management fee-funded personnel expenses increased by a more modest 10%, in line with the growth in full-time equivalents. Performance fee-related personnel expenses surged by 60% to 298 million Swiss franc. This reflects the firm's policy of allocating up to 40% of performance fees to its employees, a mechanism designed to align interests, but one that also introduces significant cost volatility. The disparity between revenue growth and profit growth, 12%, has raised questions about the scalability of the business model. Bears argue that as the firm shifts toward more resource-intensive direct investments, which now represent 65% of investment activity and 73% of realization activity, the high-touch nature of the transformational approach will continue to squeeze margins. The bull case analysis, the future of private markets. The bull case for Partners Group is rooted in the firm's ability to capture a disproportionate share of retail and private wealth capital. As institutional allocations to private markets mature, the next frontier of growth lies in the $49 trillion held by high net worth and ultra-high net worth families, a segment that remains chronically underallocated to alternative assets. The BlackRock partnership and the SMA revolution. In January 2026, Partners Group announced a transformational strategic partnership with BlackRock to launch a first-of-its-kind multi-alternatives separated managed account (SMA) for wealth platforms. This partnership is designed to overcome the traditional barriers to private market access, fragmented client experiences, limited scalability, and operational complexity. The solution provides advisors with a single subscription document to access a diversified portfolio of private equity, private credit, and real assets through 7 underlying evergreen funds. The significance of this partnership cannot be overstated. By integrating Partners Group's 25-year track record in managing evergreen funds with BlackRock's massive scale and SMA management expertise, over $250 billion in SMA AUM, the firm is positioning its products as core components of a holistic portfolio rather than tactical satellite holdings. The initial availability on the Morgan Stanley Wealth platform provides immediate access to one of the largest distribution channels in the global wealth industry. Bulls argue that this partnership will serve as a game changer, enabling Partners Group to achieve its long-term target of $450 billion in AUM by 2033. Realization Alpha and the direct investment pipeline. The firm's transformational investing model focuses on driving EBITDA growth through operational improvements, a strategy that is particularly effective in high valuation environments where multiple expansion is limited. In 2025, Partners Group realized $26 billion for its clients, with a focus on mature assets from pre-2022 vintages. 2 specific case studies illustrate the firm's ability to generate significant returns through active ownership. Techem. Acquired in 2018, this energy services provider was transformed into a digital-first sub-metering leader. During the investment period, revenues reached over €1 billion, and EBITDA grew by approximately 50%. The 2025 exit to a new consortium valued the company at an enterprise value of €6.7 billion, representing a successful cycle of value creation. PCI Pharma Services. Initially a majority investment in 2016, PCI was repositioned from a regional packaging firm to a global contract development and manufacturing organization. The 2025 exit generated significant returns for clients, and Partners Group agreed to reinvest a minority stake to support the next phase of growth, valuing the Partners Group Private Equity Limited stake at approximately €83 million. These exits demonstrate that Partners Group can successfully liquidate large-scale direct assets, even in a challenging M&A environment. The firm currently holds $98 billion in direct investments made during the 2020-2025 period. Bulls believe that as these assets mature, the firm will unlock a massive pipeline of performance fees, justifying the forward-looking guidance for performance income to account for 25–40% of total revenues from 2026 onward. Fundraising momentum and market share gains. While the broader private equity industry has struggled with a flat line in fundraising, rising only 0.37% globally in the most recent PEI 300 ranking, Partners Group has demonstrated superior momentum. In 2025, the firm raised $30 billion in new assets, outperforming industry benchmarks significantly. This included a record year for both mandates and evergreen programs, with these bespoke solutions now representing 72% of total capital raised. The ability to gain market share in a difficult environment is a testament to the firm's differentiated product suite. Partners Group's fundraising was 59% above 2019 levels in 2025, whereas the broader industry remained 11% below those levels. This resilience suggests that the firm's brand and specialized focus on bespoke client outcomes are resonating with institutional and private wealth investors alike. The bear case: structural vulnerabilities and market risks. The bear case for Partners Group centers on the high sensitivity of its earnings to realization timing, the potential for margin compression as it pivots to lower-yield asset classes, and the existential threat posed by AI-driven disruption in its core sectors. The performance fee cliff and pull-forward effects. One of the primary catalysts for the March 2026 stock plunge was management's warning regarding the 2026 performance fee outlook. While 2025 saw a record surge in realizations, Chief Financial Officer Joris Groflin noted that the firm had accelerated several large transactions from its pipeline into 2025. This pull-forward effect means that performance fees in 2026 are expected to be in the lower part of the communicated 25–40% range. Bears argue that this cyclicality makes Partners Group a volatile deal-driven stock rather than a stable, fee-compounding asset manager. If macroeconomic conditions worsen or M&A activity stalls, the firm could face a prolonged period of subdued performance fees, making it difficult to sustain the high dividend payout and the current valuation multiples. Private credit: scale versus margin pressure. In response to institutional demand for yield, Partners Group has aggressively expanded its private credit offerings, which now account for 25% of total AUM. While this shift provides scale and recurring management fees, it also introduces structural margin pressure. Private credit funds typically offer leaner management fee margins and lower performance fee potential compared to the firm's flagship direct private equity programs. Morningstar analysts have warned that the pivot to lower margin private credit adds further pressure to the firm's profitability profile. Furthermore, as interest rates moderate in 2026, the absolute returns from private credit may decline, making these products a harder sell for advisors who are increasingly scrutinizing the illiquidity premium of alternative assets. The potential for redemptions in open-ended private credit funds remains a latent risk, particularly if concerns about portfolio company defaults or valuation marks intensify. The AI disruption threat and software exposure. The early 2026 sell-off was exacerbated by specific concerns regarding the impact of artificial intelligence on the software and software-as-a-service sectors. Private credit and private equity have historically been heavily allocated to software, an industry that is now perceived to be at risk of massive disruption. Some observers have pointed to a potential bubble in the technology sector overall that could have a cascading effect on private market valuations. Partners Group has moved to mitigate these fears by highlighting that its software exposure is less than half the industry average. The firm purposefully exited its cloud software portfolio company, Civica, in 2023 as part of an early assessment of these risks. However, bears maintain that even a limited exposure could be problematic if the tech-driven transformation leads to a broader re-rating of private market assets. Within the firm's $56 billion in evergreen assets, 10% has private credit exposure, and within private equity, software acts as a direct lead for 1.8% of assets. While these numbers are relatively low, any contagion in the software-focused credit market could lead to a liquidity crunch or valuation write-downs across the broader sector. Dividend coverage and financial structure. The sustainability of Partners Group's dividend has come under scrutiny following the 2025 earnings miss. The board proposed a dividend of 46 Swiss franc per share, a 10% increase, which yields approximately 5.7% at current prices. However, analysts have noted that the dividend is not well covered by earnings in the current period. With net profit growth, 12%, lagging behind the increase in performance-related costs and the dividend hike, the firm is utilizing a significant portion of its free cash flow to maintain the payout. Furthermore, the firm carries a high level of debt, and its price-to-earnings ratio remains slightly above the industry average despite the stock plunge. If the firm is forced to choose between funding its resource-intensive transformational operations and maintaining its 17-year streak of dividend increases, the resulting capital allocation decision could alienate a significant portion of its retail and private wealth shareholder base. Performance and margins. In terms of profitability, Partners Group's EBITDA margin of 63% is exceptionally strong compared to traditional asset managers, but it faces pressure from the conglomerate models of U.S. peers. KKR, which has a significant insurance segment, Global Atlantic, reported a net profit margin of approximately 15.55% for Q3 2025, while Blackstone's trailing 12-month operating margin stands at a robust 58.21%. Partners Group's return on equity, ROE, of 55% remains a standout metric, significantly higher than many of its global peers. This high ROE is a key pillar of the bull case, as it suggests that the firm is exceptionally efficient at generating profit from its shareholder capital. However, maintaining this ROE will require the firm to successfully navigate the rising personnel costs and potential performance fee fluctuations anticipated in 2026. The sovereign wealth fund threat. An emerging competitive threat comes from sovereign wealth funds, which are increasingly bypassing private equity firms to make direct investments. Institutions like Norway's government pension fund Global, $2 trillion, and Saudi Arabia's PIF are now larger than the biggest PE firms and are leading major acquisitions, such as the $55 billion take-private of Electronic Arts. This going direct trend reduces the fee pool available to managers like Partners Group. SWFs have a structural advantage due to their multi-decade investment horizons and absence of fundraising pressure. While Partners Group still partners with these entities, as seen in the Techem exit, where GIC and Mubadala were part of the new ownership consortium, the firm must continuously prove that its operational value add justifies its management and performance fees in an era of sovereign dominance. Macroeconomic context: investing at high altitude. The firm's 2026 outlook, Investing at High Altitude, frames the current market environment as one of historic peaks and necessary caution. This macro view has several implications for both the bull and bear cases. Interest rates and private credit resilience. Partners Group anticipates continued policy support in 2026, with the U.S. Federal Reserve delivering rate cuts and the European Central Bank (ECB) potentially reaching a terminal rate near 1.5%. Approximately $11 trillion in floating rate debt is set to benefit from these lower interest expenses, easing refinancing pressure ahead of a major maturity wall in 2026-2027. Bulls see this as a tailwind for the firm's private credit portfolio and for M&A activity generally. Lower borrowing costs improve the profitability of portfolio companies and make debt-financed buyouts more accretive. However, if rate cuts are delayed or if inflation proves sticky, the maturity wall could become a significant source of distress for mid-market companies that are over-leveraged. Infrastructure as a strategic overweight. In an environment of economic uncertainty, Partners Group has strategically positioned infrastructure as a core overweight. The firm highlights the critical modernization phase required after decades of underinvestment in roads, bridges, and electric grids. AI adoption is also driving massive demand for data centers and power systems, requiring trillions in investment. The firm's focus on mid-market infrastructure secondaries and direct U.S. power assets provide inflation protection and secular growth. This strategic tilt is a key component of the bull case, as it aligns the firm with long-term megatrends that are relatively insulated from the volatility of consumer discretionary spending. Partners Group's global footprint, with 46% of AUM in the Americas and 42% in Europe, means it is acutely sensitive to regional dynamics. The firm's ability to allocate capital across regions based on relative value is a critical management skill that bulls believe will mitigate localized downturns. The regulatory landscape, evolving standards in Switzerland and beyond. As a Swiss-listed firm, Partners Group is navigating a rapidly changing regulatory environment that emphasizes transparency and investor protection. FINMA and the LEDA legislation. In the second half of 2026, the Federal Act on the Transparency of Legal Entities and the Identification of Beneficial Owners, LEDA, will come into force. This will create a centralized federal register where companies must record information about their beneficial owners to prevent money laundering and sanctions evasion. Capital adequacy and banking indirect impact. Amendments to the Swiss Capital Adequacy Ordinance, CAO, that took effect in 2025 continue to shape the availability of business lending into 2026. Non-systemic banks must maintain minimum regulatory capital of at least 8% of risk-weighted assets. This may indirectly impact Partners Group by tightening credit conditions for the mid-market companies that the firm targets for investment. Valuation. The 37% stock price decline in March 2026 has pushed Partners Group into oversold territory, according to Relative Strength Index (RSI) analysis. Bulls point to that the long-term fundamentals of the firm remain intact. The high flyer classification by some investment platforms suggests that while momentum is currently negative, the underlying quality of the business, ROE, asset growth, remains in the top tier of the industry. DCF valuation and market sentiment. Discounted cash flow models suggest that the firm is significantly undervalued. Fair value estimates range from 1,251 Swiss franc to as high as 1,344 Swiss franc. At the current price, the stock is trading at a discount of nearly 40% to its estimated future cash flow value. The bear case counter-argument is that DCF models are highly sensitive to growth and terminal margin assumptions. If the market is correct in its skepticism about margin sustainability and the permanence of performance fee volatility, then the fair value uplift may never materialize. The disconnect between operational achievements and market valuation represents a major challenge for management credibility that will only be resolved if the firm can demonstrate improved cost discipline in the second half of 2026. Conclusion. The bull case is built on a decade-long horizon. The firm is the undisputed pioneer of private market democratization, and its partnership with BlackRock provides a scalable engine to tap into trillions of dollars of wealth capital. Its focus on transformational investing in resilient sectors like infrastructure and healthcare should continue to generate alpha, regardless of the broader market environment. The high ROE and strong dividend yield, if sustained, offer an attractive entry point for long-term value investors. The bear case is more immediate. The firm faces an earnings cliff in 2026 as performance fees decline from their 2025 peak. Rising personnel costs and a shift toward lower-margin private credit could permanently lower the firm's profitability profile. Moreover, the structural threat of AI disruption in the software sector and the going direct trend of sovereign wealth funds could erode the firm's competitive moat. Ultimately, the future of Partners Group will depend on its ability to translate its operational transformational success into financial leverage success. Investors must decide whether the March 2026 plunge was a rational re-rating of a cyclical business or an irrational overreaction to a short-term EPS miss.